Good morning and welcome to our webinar this morning, and thank you for joining us. I'd like to thank you all and for all of our clients, families, businesses and charities and our professional referrer network who are in attendance today. I am your co-host. For those of you who don't know me, my name is Robert Smith and I am a portfolio manager here at Compass Private Wealth. We will be discussing probably two of the most talked about topics in society at the moment, which is interest rates and inflation, particularly for ourselves in the context of portfolio management. In terms of housekeeping, we will just bring up our housekeeping slide now. We always have to do a little bit of housekeeping. Questions can be submitted during the webinar by clicking on the Q&A button and typing on your question. As you can see, in terms of the webinar, it will be recorded for anyone who would like to watch it back afterwards. And also slides will be made available after the webinar for your viewing later. In terms of our team, you will see that there's some familiar faces and some new people also. Myself, Catherine and Lee Darcy, and Joey and Jonathan as well would be more familiar to yourselves. In terms of our host this morning, that will be Jonathan Shahan himself, who is the Managing Director of Compass Private Wealth, who will be guiding us through these topics in far more detail. And with no further ado, I will pass you over to Jonathan.
Thank you very much, Robert, for that lovely introduction, and thank you to all of you for taking the time this morning to register. We decided to run this webinar about a month ago because inflation was, as Robert said, the hot topic, and it continues to be. So we've got 5 different sections I'm going to run through this morning, and at the end we'll have a Q&A. So as Robert says, do put your questions through the Q&A button. We'll actually see those questions coming in live, so we may actually answer them as we go. If not, we'll have some time for questions and answers at the end. So firstly, from a high level point of view, I just wanted to discuss where we are in investment markets. The first thing with equities, we have seen a lot of volatility so far this year. In the next slide, I'm going to show you some year-to-date returns from the various indices. But from March 2020, after the initial sell-off of COVID-19 for the 4 weeks from about the 20th of February to the 20th of March, we've seen a sustained recovery for 22 months, right up until mid-January of this year, in what we call the post-COVID rally. But we have seen significant volatility ever since. In terms of bonds, we've seen a continued increase in interest rates, which leads to a drop in the value of, which leads to a drop in the value of capital of the bonds. So we've seen bond yields rise, and therefore the capital value of bonds decrease significantly over the last 2 months or so. Next, we have property. So the performance of property is completely varied, dependent on residential property or commercial property. Residential property in Ireland continues to increase at a current rate of about 15% on a 12-month basis in terms of capital values. And commercial property is very much dependent on the asset, the sector, the location. Another very important asset class is cash and savings. And ultimately, because of the low interest rate environment, firstly, deposit rates went to 0, and now deposit rates are actually minus 0.2% in some cases when the value is over $1 million, or for certain pensions or charities at certain levels. So we're now in an environment where the return on deposit is 0 at best. And actually, when you factor in current account fees and different things, for people with a higher quantity of smaller current accounts, for example, they're actually negative yielding because of the current account fees that we're seeing come back into the market. And then other asset classes that are relevant. We have seen a strengthening of the dollar, in particular against the euro. Now, what that does is, even if the US stock market falls in dollar terms, actually, when the dollar has strengthened relative to the euro, it helps Irish-based investors, because if the dollar goes from 115 to 108, that 4 or 5% increase, or whatever it might be, can also always help a portfolio even if the S&P 500 has fallen. We've also seen a huge rise in the price of commodities, oil, natural gas, because of everything that's going on in Ukraine at the moment. So what I'm going to show you here before I bring up the chart is the major stock market, geographical stock market indexes and how they performed year to date. So there's a lot of colors going on here. We will send these slides out afterwards so you can study them in your own time, but in the yellow at the very top, ironically, given everything that's happened with Brexit, the FTSE 100 in euro terms, so the FTSE 100, the top 100 companies in the UK, has been the highest relative performer so far this year. And bottom of the pile, minus 20% in euro terms is the NASDAQ, which is the technology index in the US. Next bottom would be the Euronext Dublin, which is the ISEC, the Irish Stock Exchange, which is down 15%. So what we've seen is continental Europe has been the most negatively affected this year because of the proximity and reliance on Russia and the exposure of the invasion of Ukraine. So what they say, a picture paints 1,000 words. What this chart will highlight to you is the extent of the volatility and the market weakness which we've experienced year to date. Okay, so now I'm going to speak about inflation. And before I do, I came across a really, really good video. So I'm going to play this video. It's about 2.5 minutes long. The CSO website is an excellent website. I spent a lot of time on it over the last couple of weeks preparing for this. So I'm going to play this video now for a couple of minutes, and then we'll talk more about inflation once it's completed.
Ireland's Consumer Price Index, CPI, is the official indicator of inflation for Ireland and is often misunderstood. The CPI provides a measure of average price changes for goods and services purchased by consumers in Ireland. Produced by the Central Statistics Office, Ireland's CPI provides an accurate way to adjust wages and social welfare payments in an ever-changing economy. Another important use is in pension payments, which can be adjusted over time using the CPI. Economists and government departments also use the CPI as a tool to measure the performance of the economy and to inform public policy. Imagine a shopping basket filled with common items that are purchased by households in Ireland. The prices are continuously tracked in this basket each month over time. The price change of this like-for-like basket comparison provides a pure price change which indicates the level of inflation. Over 50,000 prices are collected monthly. The majority of prices are collected in retail outlets throughout Ireland by our field pricers using a specially designed smartphone app. The field pricers record the prices of identical products in their designated outlets each month. CSO staff members also collect a number of other prices, online, by telephone and by written correspondence. These include airfares, motor insurance and utility bills, among many others. Similar methods are used right across Europe to ensure that our inflation rate is comparable with the rate in other EU countries. Items included in the CPI reflect the groceries people buy, gas and electricity rates paid, the price of a pint, bus fares, amongst many more. Each item included is given a weight based on the amount households spend on each item. For example, a much larger proportion of spending is spent on petrol than salt. Therefore, petrol gets a much larger weight than salt in the CPI basket. These weights are changed annually using other statistics on consumer spending. The index is reviewed periodically to ensure that it remains representative of what people are buying in Ireland. For example, the CPI would have included video players and video rental before. Now it includes smartphones and streaming services. So now you know what Ireland's Consumer Price Index is.
So I hope you found that video useful. I thought it was very, very clear and simple, just to explain exactly what the CPI is and what the CSO do. So really, when we look at the published CSO data, it's looking at a basket of goods and services, and that's reweighted and changed on an annual basis. So the official definition from the IMF is inflation measures how much more expensive a set of goods or services become over a certain period, usually a year. Now, other terminology that's linked to inflation, it's always also very relevant to understand what it is. One which might become apparent soon is disinflation, okay? Now what that is if in Ireland we're running at 6.7% annualized inflation at the moment, if that goes to 5% or 4%, we're still in an inflationary environment, but it's disinflation and that the inflation rate is growing. That'll be one to watch out for. Another is deflation. Now, any clients of ours here on the call would have remembered me speaking about inflation a lot up to about 2 years ago, because for a period there, Ireland and the world was looking at a potentially deflationary environment. And what deflation is, it's the opposite to inflation. It's where, you know, things like efficiencies and globalization and technology and all that can actually lead to continuous price decreases. Now, deflation is arguably as dangerous for certain people as inflation, because if we're in a deflationary environment, people will say, well, I'm not going to buy that good or invest in this product now or avail of this service now, because in 12 months' time, those goods or services will be lower cost. So what happens is that consumers retrench and nobody spends or invests, leading to a complete fall off in VAT revenues and government, you know, corporation tax profits, all that type of thing. The next one is stagflation. And this is also going to be very relevant in the months and potentially years ahead. Stagflation is where prices are rising, so inflation is running at a rate higher than economic growth. So if you're in an economic growth environment where GDP is increasing by 1% per annum, but inflation is running at 6% per annum, that 5% gap is what stagflation is. Now, there's also what I call portfolio stagflation, which is where a portfolio may not be dropping in nominal terms, but a portfolio of assets might be increasing at 1% per annum, but if inflation is running at 5% per annum, that's portfolio stagflation. So stagflation is, you know, potentially we're already there at stagflation, but it's going to become more and more relevant over the months and years ahead. And the next one we're very familiar with is recession. And actually what a recession is, it's only 2 consecutive quarters of negative GDP growth. So often people talk about, oh God, we might be entering a recessionary environment. And when Irish people say that, we probably think back to what happened in 2008, 2009, and that 3 or 4 year period after the global financial crisis. But actually we could enter into a recession and barely notice it. If your GDP growth has been increasing substantially for a number of years, like Ireland's has, all it means is 2 consecutive quarters and you're officially in a recession. So I'd say always just be mindful of what people mean when they talk about recession, because a recession in the strict definition may not be as severe as people think. So measuring inflation, as we saw from the video, it's monthly monitoring by the CSO. In March last month, the rate in Ireland was officially 6.7%. on a 12-month basis and 1.9%. I'll show you some lovely charts shortly in terms of the historic Irish CSO data, but officially we're at the highest inflation rate in 22 years at the moment. This is again from the CSO, and this shows the various sectors that comprise the CPI on the last 12-month basis, so where the 6.7% comes from. And you can see the 2 big outliers here are the biggest one being transport, which is up over 18% on the year. And the second culprit is the housing, water, electricity and gas. And it's quite clear from this that the obvious factor here is energy. And those 2 particularly have disproportionately affected everything else. So certain things like education, health has barely moved, clothing and footwear has actually dropped. So it's those two particular sectors, and it's very important to look at that in the context of the CSO. And all of this data is freely available on the CSO website. It's really, really insightful, actually, when you're looking at the overall basket of goods or services. Now, let's look at inflation over other periods in Ireland. As I said, the last 12 months, 6.7%. Now, I'm going to show these coming up in different bullet points, and you can guess as we go. What do you think that the inflation rate officially in Ireland was in the 12 previous months? 0%. What was the inflation rate for the 13 years up to March 2021? 1.9%. That's not 1.9% per annum. That's 1.9% in total. So I do think inflation is a very, very big deal, but we kind of need to put a bit of context, historical context onto it. And actually, when you compare the current inflation rate to what we've enjoyed, I'm not sure is enjoyed the right word, but the environment, inflationary environment we've had for the last 13 years before that, 14 years, was extremely benign. So we almost got into a false sense of security, or a bit complacent that this is the way prices are going to go forever, that they'll stay the same. But if we look back, and a lot of clients in this room have had conversations with me, those who were in business in the 70s and 80s in Ireland, if we just look at a 24-month period from March 73 to March 75, the inflation rate in Ireland was 40%. 5 years from March 1970, nearly 86% in that period. And in the 10 years from 1970 to 1980, 248%. So when people talk about inflation in the 70s and the 80s, this is exactly what they're referring to. So we do have to, again, remember what's gone on in the past, both the recent past and also not too long ago in the 70s and 80s, to know what inflation can actually be capable of doing. This is a chart for the last 25 years. So you'll see that we did actually enter a negative inflationary environment for a period of time around the end of 2008, 2009, 2010. And that's why the inflation rate was effectively 0 or 2% in that 13-year period. So now we've seen a bit of a spike, getting back to where it was in 2001, 2002. And potentially a better chart here is the same inflation rate in Ireland, but over 45 years. So some of the data I showed you earlier was actually from this 1970s, but you look here at the early 1980s and you see the level of inflation we had in Ireland at that point in time also. So again, the purpose of this really is just to put the current rate in context. I'd love to be able to show you a chart as to what inflation is going to be for the next 10 years, but unfortunately, we just don't know that. So why are we currently in a 6.7% inflation and potentially getting up to double digits? In the US certainly is closer to that than Ireland is at the moment, but potentially in Ireland and Europe. We've had the perfect storm. After the global financial crisis, interest rates were slashed, quantitative easing was put in place, and this created a low interest rate environment because the world needed it. And that then creates more surplus liquidity and capital in the system, and that inflation is caused by the quantity of money in the system, which we know there's a lot of it, but also how fast that money works around the system. And we're seeing that at the moment, that the low interest rate policy we've had for years has now created a level of inflation. That was the first factor. The second one is COVID-19. So this little chart is up here. On the left, we've got, roughly speaking, in a normal economic environment, demand will reach supply with the odd anomaly. But on a global basis, if there's demand for goods and services, suppliers and providers, they'll match demand. They might exceed demand, and then there might be a bit of a leveling off. So that's a normal environment. What happened from ultimately spring of 2020 was that economies went into lockdown. We had a 2-kilometre rule for a while in Ireland, and so people couldn't spend. So demand fell through the floor, and supply, stayed thereabouts for a couple of months. And supply realised we actually can't afford to keep all these staff, to have all these infrastructure and services in place. So what happened is supply dropped enormously. And kind of unexpectedly, and maybe quicker than one anticipated, demand has now gone right back up, probably to a higher level than it was pre-COVID, because of the fact that a lot of people have surplus savings globally because of all the different stimulus measures that were put in place. But supply, not only can it not keep up, but it's also being constrained by supply chain factors that we're acutely aware of in the auto industry and different industries. And obviously what's going on in the third one here is the Russian invasion of Ukraine. So those three factors have created this perfect storm where there's basically more demand than supply. And you could look at the Dublin airport queuing as an example of, there's now probably more demand for flights than there was before COVID. But the Dublin Airport Authority just don't have the infrastructure in place or the staff because people were let go and that type of thing. But that's just one example. But pretty much every industry, semiconductors for the auto industry means that if you look to buy a car now, electric car, you're going to be 12 months waiting. Somebody I know was looking to buy couches recently for a new house, 12 months before they'd be delivered, that type of thing. So they're creating inflation. Now, what is monetary policy? So the role of central banks is price stability. So I was reading Goldilocks to my little girl recently, and the whole thing is that the porridge is not too hot, not too cold, and that's what the economic metaphor is. Not too hot, not too cold. Central banks want price stability. So Joe Bloggs should be able to look at the CSO data and the RT News to say prices are rising by 2%. Joe Bloggs should be able to go into the bank and get 1.5 or 1.75% on deposit for his deposits. And also Joe Bloggs should be able to borrow money at 3.5%. So you want deposit rates, interest rates, and inflation data to be all roughly the same. How do they do this? They increase interest rates. Therefore, that makes borrowing and speculating more expensive because interest rates are higher, and also reward savers. So when we're seeing in the US at the moment, they're hiking interest rates, that rewards those who want to place money on deposit, and it makes it more expensive to speculate and borrow. And that's exactly what's going to be happening in Europe over the coming months and years. And when you want to stimulate an economy, if if an economy goes into recession or there's this low consumer spending, that type of thing, you decrease interest rates to stimulate an economy. That's the main tool a central bank has. And we know the governing council in Europe, and they all vote and that type of thing. So that's really what the main purpose of central banks are. For example, the US Federal Reserve, they've gone from pretty much a zero rate, and it now looks like by the end of this year, they could be as high as 3% in their base interest rates. So what they've decided to do is most central banks increase by 0.25% at every meeting or when they meet. But Jay Powell has now said that they'll probably increase by 0.5% next month. And they could be extremely aggressive because the US, I think the inflation there is 8.5%. So they're going to put a lot of interest rate rises in place over the coming 12 months or so. In Europe, the overnight deposit facility is actually minus 0.5% in Europe at the moment. So when we increase rates, we'd be moving from 0.5% minus to 0.5%, 0.25% minus. But all the indications were for all of 2021 that there's no way the European Central Bank will increase rates until even 2024. But that's all changed. And the signs are that I personally expect that there'll be an interest rate increase in Europe this year in 2022. And once it starts, the seal is broken, and then it could be every meeting thereafter. And I do think that if inflation isn't contained naturally, that we could see interest rate rises. Just going back to the previous slide, why? Because if the European Central Bank increase rates, they're actually rewarding people to not invest or spend and instead put it on deposit. And they're also penalizing people who want to borrow money for investment purposes. So when does inflation get worse? Well, if goods and services increase in value and we're in a low inflationary environment, then workers are going to need more wages. We're obviously seeing that now with the teachers' unions and things at the moment, and that's going to be the hot topic for the next 6-12 months, because in fairness, their costs of living have increased. They need higher wages, which in turn feeds higher inflation. Or Mary Murphy decides that prices are increasing all the time, so therefore she decides to buy now because I want to buy a car now for 20 grand because I anticipate that in 12 months time it'll be 24 grand. So people get into this spiral, which again causes future inflation. That's where the role of governments and central banks becomes very important. And deflation, I know we're talking about inflation today, but deflation is important. If one anticipates prices falling, then people defer spending, and therefore this actually itself creates an economic slowdown because there's no VAT receipts or exchequer receipts, that type of thing, which might prolong a deflationary or recessionary environment. So in Ireland, the good thing is that being a member of the EU hugely reduced the volatility. If you look at the inflation rates in Ireland compared to the other EU, Euro countries, they're actually all quite similar. If we were just in the punt, maybe pegged to sterling, like back in the day, we could see inflation skyrocket. Maybe I suspect that's what happened a lot in the 70s and the 80s in Ireland. When you're a member of a single currency system, it does reduce the volatility, thankfully. However, what Brussels decides in terms of the base rate may not be appropriate for Ireland at a point in time. I suppose because we are a different economy to everybody else, we're similar in a lot of ways. But if I look at 2005 and 2006, the European base rates were just too low for Ireland. Money was too cheap back then. If we had control of our own, if we had the Irish Central Bank setting interest rates, interest rates would probably have been twice as high as what Brussels said we had to have them. And equally, after the global financial crisis, Ireland actually needed lower rates, but rates were too high in Europe for a while. So that's a challenge you have in Ireland. Now, what fiscal policies do, fiscal means, I suppose, government spending, that the government here can try and control inflation, but it's quite difficult because so much of it comes from outside of Ireland. And one way of doing that, for example, is cutting VAT or excise duty or whatever it might be, cutting or increasing interest rates or increasing or decreasing tax and that type of thing. So asset classes, winners and losers. So you say to me now, Jonathan, this is all great, but how does that affect my portfolio, or if it's a charity or long-term portfolio or business assets, whatever it might be? So certain asset classes and investment types perform better than others, but there's no single bullet here. So I'm just going to go through a few of them. A long-dated conventional bond will certainly lose nominal value in a high inflationary environment. So if I buy a 20-year government bond from the German government, and that's giving me a 2% return every year, I might say, well, actually, when inflation's at 0, 2% return every year is 2% better than 0, so that's great. But if I buy that for 20 years, and in 3 years later, inflation's at 4%, then the 2% I'm earning has stayed the same because it's nominal. It's a nominal conventional bond. So therefore, I'm actually losing 2% every year. So the capital value of that 20-year bond that's listed on the stock exchange would hugely fall in value on the secondary. So if I bought that for €1,000, for example, you'd suspect the price might have fallen then to 85 or 90 euros because of or 900 euros. So it might have fallen by about 10% because of the inflationary environment. So long dated fixed conventional bonds will fall in the higher inflation environment. Equities are designed to perform well, but it does depend on the company, the sector, the skill of the manager, and the type of equity in the sector it's in. Now, cash, you will suffer from portfolio stagflation because the cash deposit rate will never achieve the same as what inflation is, but there is the huge benefit of cash, of liquidity. So sometimes you need to kind of accept that with your cash assets, that element of my portfolio will certainly lose value, but having liquidity and security is more important than putting the capital at risk. And residential property will typically, and I'll qualify that in the next slide, will be an inflation hedge as rents will increase in line with inflation. So who are the winners from inflation? So borrowers who have rates linked to base central bank rates in a low inflationary environment will do well. So anybody here who has borrowings from properties they bought 10, 15 years ago that are on tracker rates or even variable rates has actually performed quite well. It's been a positive, the low inflationary environment has been positive up to now for those people because the interest rates they've been paying have been quite low. Borrowers on long-term fixed rates that are locked in at lower rates in inflation environments. So for example, getting a 10-year mortgage now would seem sensible at a rate of below, say, 3%, because that certainly won't be available in 2 or 3 years. So locking into long-term borrowing rates in a low interest rate environment on the assumption that interest rates will increase is a positive. Investors in equity portfolios that contain companies that perform well in an inflation environment will protect their value against inflation. And a government with, and here's the part of it, that when a government has huge debts on their balance sheet, and the government debt, actually, and inflation is a subtle way of eroding the value of that debt away, because remember, debt is nominal, the capital is nominal. And if you're in a 6 or 7% inflation environment, a few years of that, and the nominal debt itself becomes more affordable as such. The losers from inflation, so somebody who has all of their capital in cash over the long term in a high inflationary, low deposit rate environment, will obviously lose relative value. So if inflation is running at 7% and they're earning 0 or even 1%, they're losing out consistently over time. Obviously, cash is very important from a tactical point of view, but long term, it certainly wouldn't make sense to have too much of a portfolio in cash. Owners of residential property in the rent pressure zones in Ireland, you're now capped at 2%. So your maximum is a 2% rent increase in a 7% inflation environment. So at the moment, unfortunately, residential property owners, in terms of income levels, are being negatively impacted by inflation. People who try to catch inflation, so we have to see this with charities a lot, or different, where they feel as though there's a bit of panic there because, oh God, I've got too much in cash and inflation's at 7%. And unfortunately, some investment companies are advertising, by way of, frankly, a bit of scaremongering, trying to lure people into investing money. It's so important to stick to your asset allocation principles, and we'll talk about that in a minute, and not to be coerced into investing just because you might lose out for a couple of years on an inflationary environment. And those who have fixed incomes, like pensions, we see this a lot with life insurance or death in service, where somebody receives, you're going to get 20,000 per annum every year. The 20,000 every year becomes a lot less attractive if inflation is higher for a number of years. The 20,000 nominal is less valuable as inflation increases. So inflation and financial planning. So as you know, with Compass, we're absolutely dedicated to financial planning first and foremost, and then look at asset allocation, starting at the umbrella view and looking down. So I'm trying to kind of contextualize a lot of what's going on here. We're in the fortunate position that because we don't sell proprietary products, we don't have proprietary funds, we never feel as though, our clients never feel as though we're pushing them in any way. So a lot of it is really understanding what your situation is, having your plan, financial plan, asset allocation philosophy, and then working into your plan to deal with inflation based on them. So one thing we have to realize is that all that CSO data is lovely to and understandable to look at, but published inflation data is useful, but actually it's just very generic. So you need to know what your inflation numbers are. And this is where, unfortunately, the calculator might have to come out, or the spreadsheet. If it's a business or you're a business owner, you need to look at your business costs. If you're a charity, you need to sit down and say, what's our budget for the next year, whatever it might be. And families and households, you need to look at your overall situation and say, well, how is inflation affecting us? So for example, healthcare. Now, healthcare often increases more so because of regulation than it does because of other factors. But some people, maybe younger people are less impacted by inflation or by healthcare because their only health expenses are their VHI or whatever it might be, and the odd physio or GP or dental appointment, whatever it might be. But elderly people or people who charities with home healthcare costs or whatever it might be disproportionately affected by healthcare. Now, you could say the healthcare in the current inflation numbers is underrepresented because it's all about energy. So that's why it's important to know what your costs are. Travel is very important. Personally, I love getting my dart in from Portmarnock to the office every day. Very, very rarely drive. So for certain people who don't travel in a car, for example, or don't fly overseas, they mightn't notice any difference that the cost of diesel or petrol because they simply don't travel and they don't consume in that way. House running costs. So unfortunately, the bigger the house and the less well insulated it is, the higher the energy costs are going to be, the higher the upkeep. So somebody in a small compact place, maybe it's a family and the kids have moved out, whatever it is, and they decide to downsize and they're in a nice compact energy rated house, will obviously have a lot less cost than somebody with surplus land or more rooms to heat, and they could see that the house running costs significantly increase, which would be probably the most affected by the current inflation. Debt servicing costs. So a lot of people are complacent and aren't based on the low interest rates we've had, but actually if you have a tracker, a variable rate, loans coming off maturities, you're going to have to accept that interest rates are going to increase, and that becomes affordable for you to the expectation. If you're borrowing money or any type of business, you need to factor in debt servicing costs and any other fixed outgoings that are linked to inflation. So for anybody watching this, you have to understand what your costs are and anticipate that increasing into the future. So the key rules: stick to your financial plan or asset allocation strategy, regardless of the economic environment, inflation or deflation, or risk on, risk off. So all our clients know that you don't react needlessly, knee-jerk reaction to what's happening if markets are volatile, if markets are benign, if we're deflation, inflation. So you need to just stick to your guns. The whole reason for having diversified portfolio is to withstand shocks like this. So your diversified portfolio, if you have decided to keep 20% in cash, you have 20% in whatever property, 40% equities and 20% alternatives, whatever it might be, you don't just change that. Oh God, we're inflation, I'm now going to decrease my cash from 20% to 2%. Because if you do that, you have 18% more in the market, and that 18% could fall by 20% if we're in inflation, if we're in a sell-off period. So regardless of the underlying market conditions or the environment, you need to have your financial plan, key philosophies, and always have it diversified to withstand asset class change, movements, inflation, deflation, all that. Always think long term. I'm not saying to ignore the current inflation, but actually considering it's only 6.7%, you look back over the previous 10, 15 years, it's been benign. These things too pass. I mean, the central banks will act in time. Europe are probably dragging their heels a bit at the moment, but it will level out in time. What I want my clients to avoid short-termism and being lured into some product or some investment because, I better invest in this to keep up with inflation. I don't think that's the correct strategy. Always try to think long-term. Ensure that your financial position exposure is on a holistic basis. So don't ever look at your pension or your one investment account or deposit account in isolation. One thing we do for all our clients, we look at the totality of their assets and say, yes, you have X amount in cash, and that might be nominally a large amount of money, but as a percentage of the overall portfolio, it's actually only 10%, say. And we'd look at that on a percentage basis and say, is it wise that you keep 10% in cash, even if you're suffering from portfolio stagflation? And that 10% might be 20%. So understanding your financial position by looking across all assets If it's a family, it's the husband, the wife, and if you've got trust accounts or partnership accounts, if it's a charity, you're looking at all the different bank accounts and investment accounts you might have. Businesses, same principles. And a bit of a plug for ourselves, frankly, is you need to trust who you're dealing with. And I think that's the most important thing in what we do in Compass Private Wealth. We don't sell proprietary products. We look on a holistic basis for all of our clients. And you need to make sure that if you're making changes to your portfolio or your asset base because of advice, that advisor has no conflicts of interest. That's it. Timing is a couple of minutes over. I'm now going to bring Robert back in, and we're going to have a couple of questions. Robert, you were fielding some questions there, so.
I am indeed. Thanks, Jonathan. Yeah, we've received quite a number of questions. I will give you the first one right here. In terms of portfolio valuations, what can we expect to see over the coming 12 to 18 months? I know you've touched on this, but if you could elaborate a little further for us, that'd be great.
Yeah, good question. Well, the first I'd say is that if you look at portfolios in the separate asset classes, you can be sure that cash is going to remain at zero for the next 12, 18 months. Even if we see interest rates in Europe, there's going to be a lag. European base rates will always increase first, and Irish banks will lag that, and they'll delay as much as possible before they increase rates, their deposit rates. In terms of other asset classes, if you asked me on a 12-month basis, will equities be higher or lower where they are today? It's probably a toss of a coin. With equities and property, over the long term, they're certain to always outperform cash on a long-term basis. But on a short-term basis, especially with everything that's going on in Ukraine at the moment, it's going to be so volatile. So I think anybody who has assets invested at any level needs to expect, anticipate, and understand that on a short-term basis, the prices are going to go up and down, and you have to have at least a 5-year view. So if you ask me, Robert, the same question, or whoever asked that question said, where will prices go over the next 12 to 18 years instead of 12 to 18 months? I would say, well, equities will be higher than where they are now, or what cash would achieve. Property will be higher. Risk assets generally will be higher. But on a 12-month basis, 12 to 18-month basis, it's going to be very volatile, and investors need to be prepared for that.
Okay, no problem. In terms of the impact on pensions long term, where do you see this going? I know you probably touched on that again, but do you see pensions contracting, or again, will you see them expanding further and rising in growth in terms of growth and value?
Yeah, I mean, the first thing is that when you look at the standard fund threshold for pensions in Ireland is 2 million, and it had been up at 5.4 million back in up to 2007, I think, or 2006 maybe. So, technically thresholds like the standard fund thresholds, like social welfare, all these government imposed thresholds or amounts should actually increase in line with inflation, but then it becomes a political thing. So, in a perfect world, I know in the UK, their max pension increases in line with kind of the CPI, or there's a bit of discretion around it. But ideally, you'd like to see that the maximum size of pensions, or the tax relief value of pensions, increase in line with inflation. We have to be very conscious of annuity rates in Ireland, because annuity rates are very, very low. So when you have a pension, you have the option to buy yourself an income for the rest of your life. And at the moment, annuity rates are extremely low, but they will get a bit higher over the next couple of years as interest rates rise. So I think generally, look at pension. An invested pension is the exact same as an investment portfolio. The only difference is that you can't touch it until you're maybe 60, or some cases 50, or whenever you retire, which might be later than 60. But it's the exact same as any other bank account or investment fund you have. It's just wrapped in a tax-free environment. So we'd always say that the bulk of your market risk or your investment risk should be in your pension, and the bulk of your personal assets should be in lower risk assets such as cash.
Thank you. Thanks for that. Slightly longer question here. It is said that the stock market is always 18 months ahead of the economy in terms of pricing in expectations. Is that the reason why the decreases in share prices have been less severe to date than expected?
Yeah, that's kind of a rule of thumb. They say that stock prices will predict the future 18 months in advance. I think to be honest, that kind of goes out the window when something like Russia, Ukraine comes along, because something as drastic and unexpected and catastrophic as that, frankly, puts every rule of investing out the window for that time. And the same in February 2020 when COVID came along. I mean, I'm in my history in this industry, I suppose. I've witnessed 4 significant events: 2008, the global financial crisis; 2012, the Eurozone crisis, where people thought Ireland might actually be kicked out of the Euro or leaving the Eurozone, and our 10-year bond was at 14% or whatever. And then COVID, and now this invasion of Ukraine by Russia. And in all those 4 periods, I think a lot of those type of metrics, like the 18 months in advance, I think all that goes out the window in an environment like this. I really do, because it just, markets hate uncertainty, and when there's uncertainty like what's happening at the moment, people just, investors just press a button to sell. They want out of the market. That creates a dip, and which what we've seen actually yesterday at markets, great recovery in the US. Sometimes markets and earnings come in, and earnings are a bit better than forecast, and then investors buy back in. That creates volatility. So I think at times like this, it's very difficult to know, does that metric stand?
Very good. Thanks for that. One more here as well. Based on the previous historical inflationary trends shown in your charts, do you feel the current inflation rises will be elongated or transitory?
I don't know. The word transitory, Robert, is, we had a chat about this. That's what all the central banks were saying last year, that this will be temporary and transitory. And I don't dispute why they felt that, but remember, that was before the Russian invasion. The reason why central bankers and economists thought it was transitory was because of what I mentioned about the demand and supply, that demand was here, supply was there, and they factored, look, supply will get up to demand. But China, Shanghai, and China's back in lockdowns in a lot of cities at the moment because of COVID. There's zero policy there. The Russia, Ukraine isn't getting any better. So I think that I really, really don't know. I think, look, on a 100-year view or a 20-year view, it's gonna come back. It's not sustainable. Double-digit inflation isn't sustainable. But we just don't know. A lot depends on, I mean, if there was an agreement between Russia and Ukraine tomorrow, I think a lot of the inflation issues could just fall away and we can enter a disinflation environment. But until we have more certainty with that, we just don't know.
Very good, thank you. One of our clients has also asked, how do you think monetary policy has impacted inflation? You touched on this slightly earlier, but if you could extend on that slightly, that'd be great.
Yeah, I mean, monetary policy, the world, US Fed, Tim Geithner was the guy at the time. I read a very good book on him, actually, if anybody was interested in that. But, with the Obama administration and Geithner, like they were extremely aggressive in what they call quantitative easing and low interest rates. And they basically slashed the cost of borrowing and brought rates down. The rest of the world followed. And that lasted for 10 years. So that accommodative interest rate policy created a lot of these inflation. They weren't to predict COVID and the Russian invasion of Ukraine. So unfortunately, that policy has created this inflation. But at the same time, if you were to weigh up all the positive outcomes of that, it's probably a net positive what was done with the accommodative policy. But it depends if inflation really gets out of hand over next year and the following year. And if we get to kind of consistent double-digit inflationary figures, then central banks are going to have to become very, very aggressive and hike rates back up, which then itself can cause inflation. So they need to find that perfect balance, or as I said, the Goldilocks scenario. So I'm just conscious of time there. So thank you, Robert, for hosting this with me today. Thanks to my other colleagues, Lee and Catherine, who are on this call as well. And thanks to all of our clients for joining us, and all our professional referrers. We're going to run another webinar on ESG in a couple of months. So we'll send you on details of that in due course. We'll also send the recording from this. One other thing I'd like to say is feel free to share this recording. Usually we keep these webinars only specific to our own client base and our own context. But I think in the context of what's going on in inflation, I'm totally happy for you to share it. So we'll send you a link with the recording, which will be on our website. And I'd love you to share that with any contacts or colleagues that you may have. Thanks again for attending, and we'll speak to you soon.